I think we can start, Rajat. We have to also respect the time of the people who have joined on
Got
time.
joined,
So I think
yes.
we can start.
Okay. Um, Good morning, everyone. Thank you for joining us all on a Sunday morning on the month end. We have with us Mr. Abin Daya, a FEMA consultant from Bangalore. Before we commence with the session officially, I request all of you to keep your mics on a muted mode, and whatever queries you have during the session, you can send it through the chat box. I'll be monitoring the chat for all the questions, which can be taken up at the end. Also, due to the paucity of time and to ensure focused discussions, this session and all the queries shall be restricted to ODI regulations only. We shall not be discussing OPI or FDI or ECB, anything else. That can be taken up later in forthcoming sessions. So, without any further ado, we should. It's all up to you. It's all yours now, Mr. Eben.
Thanks, Rajat. Good morning, everyone, and thank you for taking time out on a Sunday and having joined this session. So we wanted to give a very brief overview of overseas direct investments. Now, 2 hours is definitely not a sufficient time to talk about overseas investments and to answer all the queries. We also wanted to make this as an interactive session, which is why when Rajat sent out the form, he had also asked you for any queries that you might have. We have received a few queries. We will be taking them up. But before we get into the queries, I wanted to give a broad perspective of OI as well, because a lot of people, when they put in the comments or when they, instead of raising the queries, what they had also mentioned was that they're joining in to understand, to have a better perspective of ODI under FEMA. So what we thought was that it would be good to, to provide a brief background about how things are had to be handled as far as ODI transactions are concerned, and then move on to the queries. So that's basically how we have structured this. Additionally, if you have any queries, again, so it's also possible that any queries that you might have or which might have been raised would actually get answered when we go through the presentation itself, and subsequently, if there are any further queries, we can then take it. So moving on to overseas investments. So basically, when we talk about overseas investments, this is what we are, going to talk about. Investments in unlisted equity, unlisted debt, and non-fund based obligations. Investment in listed entity more than 10% of the paid up capital of the foreign entity. So, and we are not covering ESOPs, sweat equity, because these are primarily under OPI. So, when you look at point number 1 and 2, you will find that this is very similar to the FDI interpretation or the FDI definition. What is FDI definition? Investment to any extent, even to 1% in an unlisted entity in India by a foreign investor is considered as FDI. If it is in listed entity, more than 10% of the paid up capital is considered as FDI. Less than 10% of the paid up capital in a listed entity is considered as FPI. So that is the similar kind of definition that we can see here as well. And we will talk about resident individuals and Indian entities. Now, the underlying regulation is Overseas Investment Rules 2022 and the regulations, directions, etc., which came in on the same day, which were notified on the same date. Now, prior to 22nd of August 2022, we had FEMA 120, which governed overseas investment transactions, overseas direct investments. And in fact, prior to FEMA 120, there was another notification called the FEMA 19, which was notified in FEMA. 120 was notified only in May 2004. So prior to that, there was another notification called FEMA 19, which was notified in 2000. So 2000, transactions which happened between 2000 and 2004 were governed under FEMA 19. Then, 2004 to 2022 August governed by FEMA 120, and then was OI rules which came in 2022. When you are regularizing transactions, I'm sure you will still get a lot of transactions which have been done earlier, which need to be regularized. So you need to basically look at what exactly is the regulation applicable to that particular transaction. When did the transaction actually happen? And depending upon the timeline of the transaction, you will have to understand, or you'll have to look at the regulation or the notification or the guideline which is applicable to that particular transaction. So that is how you will have to go. What has changed between FEMA 120 and the OI rules? The first and foremost thing is that there was an understanding under FEMA 120 that when you say ODI, it covers equity, debt, guarantees, everything. So that understanding has changed. Today, ODI, when we say overseas direct investment, it very clearly talks about equity investments only. Investments done by Indian entity other than equity, basically, I mean, advancing debt, I mean, providing guarantees, etc. Those have been clubbed under financial commitment. So we have another slide where we classify this. We will talk about this a little more in detail. Second thing is that very important, the concept of control. This has been talked about for the first time in OI rules. This was not a concept which was there earlier. And there is also a very clear definition of what constitutes control. We will see that. Again, third one, under FEMA 120, RBI mentioned, RBI had very clearly given a direction stating that pricing guidelines need to be met, and this is the acceptable documentation to be provided for validating compliance with pricing guidelines. Now, that has been delegated to the authorized dealers. This is good as well as bad, right? In the sense that, I mean, decisions are decentralized. ADs can take the decision. Bad. Why? Because inconsistency. Each AD will have its own directions. RBI wants every authorized dealer to put in place a board approved policy on what kind of documentation they will take for validating compliance with pricing guidelines for each particular kind of transactions. So we have had situations where even for subscription to MOA for one of the ADs, we had to provide a valuation report. So initial days of OI rules, we had to do even that. Okay. Again, how to regularize previous non-compliances. So that, I mean, what is the process to be followed? What is the structure? What is the implication? What is the impact of not regularizing these transactions? Those have been provided very clearly in OI rules, including LSF has been introduced. Introduction of LSF has been brought in by the OI rules. Prior to August 2022, a foreign entity in which an Indian entity or a resident individual had invested were not permitted to have a step down subsidiary in India, irrespective of whatever levels. Right now, under OI rules, it is permitted again only for foreign entities in which Indian entities have invested. Resident individuals investing in a foreign entity, that particular foreign entity still does not have the ability to incorporate a step down subsidiary either in India or outside. But a foreign entity in which an Indian entity has invested, has incorporated and set up by an Indian entity can today incorporate a step down subsidiary or can invest in a step down subsidiary in India up to maximum two levels. Here it aligns with the requirements under Companies Act. Uh, Another concept which has been brought in is investment by deferred payment. And again, quite interestingly, uh, subscribing to MOA is now considered as investment by way of deferred payment. Concept of deferred payment was not there under FEMA 120, brought in OI rules, and the treatment of incorporation of a foreign entity by way of subscribing to the MOA has undergone a change between FEMA 120 and OI rules. Practically, it creates a lot of differences in handling of transactions. We will talk about that. Uh, Another thing that has been brought in is that if the foreign entity or the resident individual was either a willful defaulter or was under investigation by any of the investigating agencies, they were prohibited from, from entering into any overseas investment transactions. Now that has been liberalized, and provided the bank or the financial institution which has categorized this individual or the entity as a willful defaulter, or the investigating officer of the investigating agency does not have any objection to this individual or the entity making an overseas investment, that overseas investment transaction can now be taken up. Again, the process of obtaining the NOC is also it's basically a time bound activity in the sense that you need to the Indian entity or the resident individual has to apply for a no objection certificate. The bank has to write to the other financial institution or the investigative agency, and if the response doesn't come in a particular time, then it can be considered as an automatic approval. So this is how the overseas investment definition has got changed. So acquisition of equity capital of an unlisted foreign entity, subscription to MOA of a foreign entity, irrespective of whether it is listed or unlisted. Basically, you are becoming a promoter then. So even if it is listed, it will be considered as overseas direct investment. Investment in 10% or more of the paid up equity capital of a listed foreign entity, investment with control in less than 10% of paid up equity capital of a listed foreign entity. So these are considered as overseas direct investments. And other than that, unlisted debt in a foreign entity in which ODI is already done is part of financial commitment. Non-fund based facilities, personal guarantee, corporate guarantee, mortgage guarantee, all those things, extended to or on behalf of pledge of securities, etc., extended on behalf of foreign entities in which ODI is made. These are all considered as financial commitment. Anything beyond that is considered as overseas portfolio investment. So overseas investment is now the aggregate of all this. This is how the definition has now come together. Basic guidelines, almost all of us are clear about this, but still, just to refresh the understanding, just recapping this once. Foreign entities, Indian entities or resident individuals are permitted to invest in foreign entities engaged in permitted business. That business should be permitted to be done both in the host country as well as in India. If there is a business which is permitted in the host country but which is prohibited in India, then those kind of businesses cannot be invested into by Indian entities or resident individuals. Again, investment should only be in entities with limited liability. There is a exemption given for strategic sector. Definition of strategic sector has also been introduced over in this particular guideline. It should be within the limits permitted. 400% net worth for Indian entities, $250,000 per financial year for resident individuals. It should only be by way of permitted mode. Investment going there, the director going over there, swiping his credit card or paying cash from his pocket to incorporate an entity outside, it is not a permitted mode. Again, every transaction for a particular foreign entity should be done only through the designated authorized dealer, the same authorized dealer. If you switch banks, then there is a procedure for shifting the authorized dealer from the existing designated AD to the new AD. There is a no objection certificate that has to be obtained. There is all your previous pending non-compliances have to be closed because the new AD will not take up the headache of old legacy issues. So you'll have to clear all that. Then the transfer has to be initiated by the existing designated AD and it has to be accepted by the new AD. That is how the entire process works. And again, the Indian entity and resident individual, once they have invested in a foreign entity, there are obligations that have been imposed on them by the regulations. These need to be complied with and in the manner prescribed. Control, a concept which is defined or which has been introduced by the new rules. What is control? It is defined in the regulations as the right to appoint majority of directors or the right to control management or policy decisions, either acting alone or acting together with other people. And this right is derived out of the voting agreements or the shareholding pattern in which the Indian entity or resident individual has 10% or more voting rights of the foreign entity. This is what is defined as control in the context of overseas investment. Now, obviously, if you are a promoter of the foreign entity, you will definitely have control. Now, the challenge is, see, again, how do you evidence control? In a lot of situations, it is automatically understood. If the Indian investor holds more than 51% stake in the foreign entity, it is automatically deemed to have control of the foreign entity. And if the investor holds less than 10% stake, it is deemed to have no control in the foreign entity. But if the Indian entity or the resident individual says that I have control, even when he holds less than 10%, because if while we are looking at the classification of ODI, investment in a listed entity of up to less than 10% of the paid up capital of the listed entity with control is considered as overseas direct investment. So in those kind of cases, how will you evidence control? You will evidence control by way of subscription agreement, shareholder agreement, voting agreement, etc., etc. Again, automatically, if, in the general sense, what we take is that, or what the ADs consider is that, if the Indian entity or the resident individual holds more than 10% stake, it is automatically considered to have the investor is automatically considered to have control in the foreign entity. Now, if the investor says that I hold 15% or 20%, but I don't have control, then that is something which has to be evidenced further by the investor by way of additional documentation. Why this issue of evidencing or not evidencing control is there? Because the effect of control is what we see over here. For an Indian entity, the type of financial commitment that it can provide to the foreign entity, it differs between foreign entities in which it has control and no control. If the entity has invested in a foreign entity, two foreign entities, let's say for example A and B. In A, it has control. In B, it does not have control. It can provide equity, debt, guarantee, whatever type of financial commitment it needs or it desires in the entity in which it has control. In the entity in which it has no control, it can only provide investment or it can only infuse investment by way of equity alone. It cannot provide debt, it cannot issue guarantee on behalf of that foreign entity in which it does not hold control. So, this is where the question of evidencing control comes in. Again, for an entity in which it has control, for an entity where the Indian entity holds control, the APR should be necessarily prepared on the basis of audited financials, irrespective of whether audit is mandatory in the foreign country or not. A lot of times we hear people say that, sir, but it is not mandatory in that country. Sir, mandatory does not mean it is prohibited. Nobody is stopping you from preparing getting the audit done of the foreign entity. The regulator in the host country is not going to say that I did not ask you to prepare it, then you are so, which means that you are prohibited from preparing. There is nothing of that sort. It is not mandated. He is not saying that you have to file it, you have to do, you have to necessarily do audit. But that does not stop you from doing it on your own. So this is basically what the concept is. Irrespective of whether audit is mandatory in the host country or not, if you have control in the foreign entity, APR has to be prepared on the basis of audited financials of the foreign entity itself. Now, a lot of times the other question that we also get is that can the audit be done by an Indian auditor, or does it need to be necessarily done by a CPA or an auditor in the host country? See, FEMA does not speak about this. FEMA only says that it has to be done, APR has to be filed on the basis of audited financials. Uh, Again, a lot of banks, a lot of ADs accept APRs which are based on audited financials prepared by Indian auditors. So it is again dependent upon how your AD wants it, because ultimately he is the one who has to vet it and who has to upload it. It is just to his acceptance. and he has to vet it and he has to upload it on the OID portal of RBI. So it is on the basis of his acceptability that you'll have to prepare it. A lot of almost all ADs today accept I mean APIs which are prepared on on the basis of audited financials audited by an Indian CA, and do not necessarily demand that these be prepared or these be audited by the foreign auditors. If the Indian entity does not have control in the foreign entity, then APR can be prepared on the basis of unaudited financials as well, irrespective of whether the investment is with control or without control. Step down subsidiary is permitted by the foreign entity in India or abroad to two levels. For an investment by Indian entity. Again, coming to resident individuals, financial commitment, irrespective of whether the Indian individual holds control or no control in the foreign entity. Resident individual can provide only equity, cannot provide debt or guarantee. APR, same. If it is control, audited financials; without control, unaudited financials. Step down subsidiary. And a foreign entity in which a resident individual has invested with control cannot set up step down subsidiaries either in India or outside India. That foreign entity has to remain as a standalone entity itself. But if the resident individual does not have control in foreign entity, then that foreign entity can set up subsidiaries either in India, outside India, wherever it is. So that is again the difference between having or not having control. Investment limits, Indian entity, 400% of net worth. Earlier, there was, I think, the cap was $1 billion in a financial year, if I remember correctly. But that amount cap has now been taken out. That is 400% of the net worth. So 400% of net worth is the overall financial commitment. If the Indian entity has, overseas investments in, let's say, 10 foreign entities, then the outstanding financial commitment, aggregate financial commitment done in all these 10 or 11 entities put together should not cross 400% of the net worth as per the last audited balance sheet of the Indian entity. This is how it has to be looked at. It is not that the transaction that the entity is doing right now should not be more than 400% of the net worth. It's not that way. The outstanding overall financial commitment as on the date of the transaction should not be more than 400% of the net worth of the net worth as on the basis of the last audited financials of the Indian entity. For resident individuals, $250,000 per individual per financial year. An RI can choose to do an outward remittance or an overseas investment on 31st of March, and can again do another foreign investment, overseas investment on 1st of April, without any problem. So that can be done, but it is per financial year per individual. What constitutes overall financial commitment? So I said aggregate overall financial commitment across all foreign entities. What all does it constitute? Obviously, equity. INR value, you have to take INR value. Again, how INR value is derived, that will again come to that. Equity, loan, guarantee, bank guarantee, SBLC, etc., etc. Corporate guarantees issued by the Indian entity or any group companies of the Indian entities. Personal guarantees issued by resident promoters. Just before the session started, Rajat and we were talking about this. So personal guarantees, if you have multiple promoters or multiple individuals giving personal guarantees on behalf of the foreign entity, or promoters of the Indian entity on behalf of the foreign entity is being provided, you have to cumulate all these. If there are 5 promoters who are giving personal guarantees, you have to add all these up. PG 1, 2, 3, 4, 5, all these need to be added up. That is basically part of your financial commitment. Pledge of shares of the foreign entity or the step down subsidiary. Again, mortgage of assets of the Indian entity in India or the assets of the foreign entity outside India, all these put together is how you arrive at the overall financial commitment to understand whether the transaction is within the limits prescribed in the OI rules or not. Again, coming to how you arrive at the INR value. So, two scenarios. Let's say the total financial commitment in foreign currency, it is the same $28.8 million. Let's say USD INR on 30th April is 85.60. So if you simply multiply 28.8 million into 85.60, it is 246 crore 52 lakhs, 246.53 crores. Okay, so this is one way of doing it. The other one is list out all the transactions that have been done, as you can see on the right side of the screen. List out all transactions done for the foreign entity, and you take the exchange rate as on the date of the transaction. Multiply the foreign currency value with the exchange rate, you arrive at the INR value. You accumulate the INR value. If you do it that way, then you get it. Then you get 226.16 crores. Which of these should you take? In fact, both are correct. Okay, in the sense that typically if you accumulate the foreign currency values and you multiply it with the exchange rate, then your cumulative financial commitment in INR would definitely be higher than the other way that you are taking it. Uh, but the second way is what has been prescribed. If you look at if you look at the net worth as on 31/3/2024, if you cumulate the foreign currency values and you multiply with the current exchange rate, the the limit will come to around 403% of the net worth. So, which means the transaction is not doable. If you look at it in the second manner, you arrive at the INR value of each individual transaction, cumulate it, then this comes to about 395 or 396%, which means the transaction is doable. If you look at I mean, the statutory auditor certificate, it says that the exchange rate has to be taken either as on the date of date of the certificate or as on the date of the transaction, whichever is earlier. So the second way of doing it is more correct, where you arrive at the INR value of each individual transaction, accumulate it, and arrive at the total financial commitment in INR. That is actually the correct way of doing it. But a lot of times we do not have this kind of information available. Uh, Clients typically do not keep data in this particular manner. He will simply tell you, sir, this is basically the value, the transaction that we have done, dollar value or the foreign currency value and the foreign currency amount. This is basically what you will get. So if you're a statutory auditor signing off on the certificate, you would probably have to contend with the cumulative value of the foreign currency, cumulative foreign currency value of the transactions, and you will have to multiply it with the current exchange rate. Uh, that is also feasible. You can take that as well. Net worth is again defined for companies how it has to be arrived at paid up capital plus free reserves plus securities premium, accumulated loss minus accumulated losses, deferred expenses, miscellaneous expenses not written off. Again, coming again to net worth. Uh, See, the investment limits for resident individuals is not provided as per or is not calculated as per the net worth of the individual. It is fixed at $250,000. An example of how different banks treat this. We did overseas investment by a resident individual in December 2023. Uh, we provided the net worth amount as zero because there is no relevance of the net worth of the individual. Bank accepted it, created the investor profile of the individual in RBI's portal. It went through, transaction went through without any problem. We are currently doing through another private sector bank for another resident individual. And the bank necessarily wants the net worth of the individual to be captured because they say that it is a mandatory field in the overseas investment portal of RBI. We know that it is not a mandatory field to be filled up. So I gave them a screenshot of what we received from RBI earlier, the investor profile for the earlier resident individual. We gave it to them, and the compliance team was like, I mean, that might be the case, but this is how we do it at our bank. So you have to necessarily give the net worth of the resident individual. Thankfully, they have not asked for a CA certificate validating the net worth. They simply say that it can be a self declaration. So these kind of differences in treatment you will come across. Well, some key, I mean, differences in financial commitments done by resident individuals and Indian entities. First and foremost is the difference pertaining to investment limits. So this is for as far as resident individual is concerned, it is subsumed under the LRS limit, $250,000 per financial year per individual. Again, as I said, this is subsumed under the LRS limit. So this $250,000 is available not just for overseas investments, it is available for everything that is covered under LRS, which can include, acquisition of immovable property outside, I mean, any travel outside, the college fees or the education expenses of children who are studying outside, maintenance of, relatives who are staying outside. So medical treatment undergone outside, all this put together is part of your LRS. So this 250,000 has to be used for everything which is under LRS, including overseas investments. Second, the difference financial command for Indian entity investment limit is 400% of the net worth as per the last audited financials. Audited financials cannot be more than 18 months old as on the date of the transaction. Financial commitment can only be by way of equity when investment is done by resident individuals. Debt and non-funded exposures not permitted. For Indian entities, commitment FC can be by way of equity, debt, guarantee, etc., etc. Third one, RA can invest only in operating entities outside, cannot invest in an entity in which the foreign entity decides to open a step down subsidiary either in India or outside. For Indian entities, no such restrictions. So these are some of the key differences. I mean, people might come to you asking, sir, I mean, should I open as an individual, open a foreign company as an individual, or should I open it under my company's name? Receivables. This again comes into four in two ways. One is when a Indian investor is disinvesting from a foreign entity. Any receivables from the foreign entity should be realized and repatriated prior to the disinvestment being done. In other words, there should be no outstanding receivables from the foreign entity to the Indian investor. That is one. Second thing is that even when disinvestment is not happening, even it is a going concern, business is continuing as usual, even then the receivables need to be realized and repatriated within 90 days from the date on which these receivables fall due. So realize and repatriate all receivables pertaining to the investment done by the Indian entity or resident individual. So this could be your, from an installment of loans that have been given by the Indian entity, or the interest on loans advanced by the Indian entity, or the dividend on equity invested by the Indian entity or resident individual. So any of these kind of receivables, these need to be realized and repatriated into the current. So this deferred payment. RBI introduced in the new OI rules. Uh, and as I said, in the beginning, this changed the procedure that needs to be followed for a subscription to MOA. So when subscription to MOA happens, the share capital is not invested upfront, right? So a couple of things that have impacted. One is the definition of overseas investments, ODI, where it defines ODI as subscription to MOA. So, which means that when an Indian entity or resident individual is subscribing to the MOA of a foreign entity, it is considered that the financial commitment is being incurred at that particular moment itself, which was not the case earlier. Under FEMA 120, subscription to MOA did not create a reporting obligation on the Indian party. Reporting obligation came up only when the outward remittance was done. So typically, when you incorporate a company, you first get the company incorporated. Then there is a gap within which the bank account has to be will get opened. It could be 1 month, 2 months. I've had one case where it took about 2 years for the bank account to get opened during the COVID period. And then subsequently the outward remittance will happen. So under FEMA 120, there was no reporting obligation in this intervening period between the company getting incorporated and the outward remittance happening. So there was nothing that need to be reported. Reporting obligation came up only when the outward remittance was being done after the bank account got open. That was when it was considered that a financial commitment was being incurred, and the due date of reporting is the date of the outward remittance. That is how it was considered. But in the current scenario, the reporting obligation is placed on the Indian entity or the resident individual immediately on incorporation of the foreign entity. The due date for reporting is the date of signing the MOA or the the date of the certificate of incorporation. This is basically the due date of reporting. And if it is not reported as on that particular date, then it is considered as a delayed reporting. But on what basis do we do this reporting? Because anyway, at that point of time, there is no bank account that is open. The money will get infused only subsequently after the bank account is open. So here, FEMA today considers this particular transaction as investment by deferred payment, financial commitment by way of a deferred payment obligation. Because by signing off on the MOA, the investor is committing or is providing a commitment that I will infuse capital into the foreign entity. That is the commitment that is being provided. So because of that, the investment has to be reported as investment by deferred payment immediately on incorporation of the foreign entity. In fact, reporting has to go even prior to the foreign entity being incorporated. When the MOE is in the course of being prepared and being filed, the application being filed, the Form FC has to be filed with the AD immediately, at that stage itself, right? With an indicative date of incorporation, it has to be filed with the AD. And once the incorporation is done, once the bank account is opened, and when the outward remittance is being done, there is a second reporting that is to go. So this is basically how the transaction has to happen. So treatment of subscription to MOA under FEMA 120, subscription to MOA incorporation, it did not trigger any reporting requirement. IE needs to wait for bank account. Reporting obligation is triggered only at the time of effecting the outward remittance. Whereas in the current scenario, subscription to MOA is considered as incurring financial commitment at the time of executing the MOA or issuance of certificate of incorporation. This is considered as acquisition by way of deferred payment because the share capital is not being infused at that particular point of time. It has to be reported in Form FC as a non-funded obligation with due date as the date of MOA or COI. So what is a tentative date for incorporating the entity has to be provided while filing the Form FC. And once the company is incorporated, once the foreign entity is incorporated, certificate of incorporation is received, that has to be provided to the AD. Another key change, ODI FDI structures erstwhile not permitted for a foreign entity in which ODI was existing to create a step down subsidiary to do an FDI back into India. But currently permits Indian entities to do overseas investments in foreign entities with either step down subsidiary in India or where the foreign entity wants to incorporate a fresh step down subsidiary in India. So how does it flow? The Indian entity incorporates a foreign entity. There is a step down subsidiary first level outside India, or there can be and that step down subsidiary first level can incorporate a second level step down subsidiary. It can incorporate mean, the second level step down subsidiary outside India as well. Foreign entity can directly incorporate a first level step down subsidiary in India as well. Third level step down subsidiaries are not permitted either in India, outside India. It won't trigger a FEMA compliance requirement, but I believe under Companies Act you will find challenges. This is something which is still not very well understood. This non-compliance in reporting and this regularization. A lot of us and a lot of our clients also still believe that if a reporting was delayed but it was completed, then the transaction is considered to be regular, which is actually not the case. And RBI has very recently came out with a reminder. It was whatever that the news item which was floating around quite some time back. I mean, I think about 3 or 4 weeks back. That is not something new. RBI was only reiterating Regulation 12 of Overseas Investment Regulation, FEMA 400. It was not something which new which came up right now. So when you issue a statutory auditor certificate, stat auditors, when you are issuing a stat auditor certificate, there are a couple of things that you are declaring or you are certifying. One is that they have verified the records and certify that no delay in reporting is pending for regularization. Please understand what is the meaning of regularization. Is pending for regularization as required under Regulation 12 of Foreign Exchange Management Overseas Investment Regulations 2020. And what does Regulation 12 say? Regulation 12 says person resident in India who has made a financial commitment in a foreign entity shall not make any further financial commitment, whether fund based or non fund based, till any delay in reporting is regularized. So you have to first regularize any earlier non compliances, and then you have to make fresh infusion of capital or fresh transaction. So what do we mean by regularization? Regularization is not just completing the reporting. So to do that completion of reporting, you have to first understand what is the delay, what is the due date. So these are certain. This is not an exhaustive list of events, but still these are some of the most common ones. And what is the due date for each reporting? If the reporting has not been done on these due dates, then it is considered as a delayed reporting. And that delayed reporting simply does not get regularized by way of submitting the reporting and getting the transaction reflected in the project profile. That is only one part of regularization. Regularization requires submitting an application with RBI for payment of late submission fee applicable for that delay, getting a provisional acknowledgement issued from RBI, making payment of the late submission fee in the prescribed manner, and getting the final acknowledgement issued from RBI. That is when the delay we can say that has got regularized. Till such time you receive that final acknowledgement after payment of LSF, that reporting has not got regularized. Simply submitting the documents and getting the transaction reported, submitting the APR and getting the APR reported in the project profile or reflected in the project profile does not constitute regularization. So this is something which has to be understood very critically. It has to be educated to the customers as well. Now, Regulation 11, it also says how transactions have to be regularized or what is intended for the regularization activity. For transactions which are done after 22nd of August 2022, if the delay is up to 3 years, it can be regularized by way of payment of late submission fee. And if the delay is more than 3 years, to be regularized by way of compounding. Now, here again, if you look at it, this has been aligned with the FDI processes. FDI also, if your FCGPR is delayed, if you're filing a delayed FCGPR, if the delay is within 3 years, you can regularize it by way of late submission fee. If it is delayed beyond 3 years, then it has to be regularized by way of compounding. So This particular part is aligned with FDI. Now, for transactions which were done prior to 22nd August 2022, there is a 3-year time window provided for regularizing the transaction, which means that even if the transaction has got reported in the project profile prior to 22nd of August 2022, if there is a delay in reporting, then appropriate LSF has to be calculated, application has to be made to RBI, LSF has to be paid, and final acknowledgement obtained for these transactions. The cutoff date for doing this is 22nd of August 2025. That is 3 years from the date of the notification. What is the date of notification? 22nd August 2022. So till 22nd August 2025, this facility is available for any transaction which was done prior to 22nd August 2022 and there was a delay in the reporting. Beyond 22nd August 2025, any of all these transactions can be regularized by way of compounding only. And only after the compounding is done and the compounding penalty paid will the Indian entity be permitted to do further transactions in that overseas entity, in that foreign entity. So this is something which has to be understood very clearly. So regularization is not just completing the reporting activity, it requires payment of LSF. Even if reporting was completed prior to 22nd August 2022, LSF has to be paid before 22nd August 2025. Otherwise, future transactions will get affected. So, Rajat, can we go to the queries? I think, I mean, I have put the queries on the slide itself, so we can take it up as it is. Sure, sure. We will do that. We will do it that way. Okay. So a few queries, that we have received. So the first question is for a domestic company which is planning to acquire the shares of a foreign entity, wherein the shares are held by a resident Indian. What will be the process if both parties agree to settle the amount in Indian rupees? Whether the same will fall within the ambit of FEMA/ODI rules, as there is no drawal of foreign exchange here. There is no guidance in any regulation in this regard. Rajat, who had asked this question? I forget the name of the member who had asked this. And the first question, I think. Anyone? No, no, we can. No, no, no problem. No, no, no problem. No problem. We'll continue. We'll answer this. I just wanted to check whether that member is there in the group or not. I'm just trying to see. We can answer this. Not a problem. Nakul. Acha. Okay. No problem. I think. For the benefit of whoever is there, we will. Take this up. See, uh, there is a foreign entity where a resident individual is an existing shareholder, and this resident individual is planning to sell these shares to a domestic company. Now, Mr. Nakul's question is that the transaction will be settled in India because the buyer and the seller, both of them are in India, and therefore there is no foreign exchange involved. And since there is no foreign exchange involved, this will not be within the ambit of FEMA/ODI rules. And he believes that there is no guidance in any regulation in this regard. It is actually not true if you say that there is no guidance. It is there in Rule 17 of ODI rules. Okay, because Rule 17 states that it talks about transfer by a resident investor to another resident investor or to a non-resident investor. So it is already covered under Rule 17 of OI rules. So there is definitely a reference to these kind of transactions in the rules. So when we look at this transaction, the existing Indian investor who was invested in the foreign entity, As a result of the transaction, his investment in the foreign entity comes down, which is basically a disinvestment. And when a disinvestment is done by an Indian investor who has an existing investment, he has to report the disinvestment by way of filing Form FC Section G. This has to be supported by appropriate documentation, including valuation report, etc., etc. So that has to be submitted. Similarly, the transferee, the buyer who is acquiring these shares from the resident individual, for him, his overseas, the position of his foreign asset is going up. His I mean, equity position in the foreign entity is going up, which is basically investment. And while the Indian entity, the transferee, is making this investment, even though there is no outward remittance being done, even though the settlement is being done in India, this translates to an investment in the foreign entity, and therefore that investment has to be reported by way of filing Form FC Section A to E, along with all the other supporting documentation. One thing that is missing over here is the outward remittance. The transaction will be settled by way of transfer of funds between the transferee and the transferor. That will be done in INR. The AD who's reporting this transaction will want to see the evidence of the transaction, which can be provided by way of the bank statements of both the buyer and the seller. These can be provided to evidence that the funds have been transferred, consideration has been paid, and on the basis of this, the transaction can be reported. Second question, in case of ODI in a zero capital entity, how is the reporting needed to be done? This was asked by Pravesh Kumar. Okay. Pravesh is there in the group? Okay. Okay. See, uh, as per the definition provided in Rule 2Q of OI rules, overseas direct investment is defined as subscription to the memorandum of association of a foreign entity is is considered as overseas direct investment. So irrespective of whether the foreign entity is a zero capital entity or an entity with capital, this is an overseas direct investment, then therefore this has to be reported. So as we said, when the foreign entity's MOA is being subscribed to by the Indian investor over here, reporting in Form FC Section 8 E2E will need to be done. Forms to be filed for making ODI. I think this was by. Okay, okay. Mm. Uh, so forms to be filed for making ODI. I take it that this is by way of it can be by way of subscription to MOA or by additional infusion of capital. Now, depending upon again, it can be by way of conversion of existing loan to equity as well. So the supporting document will change depending upon the type of the transaction, whatever the kind of transaction that is being undertaken. But generally, the standard form is the Form FC Section A to Section E that has to be submitted along with the other supporting documents. Next one, what are the ODI compliances to be taken care while a limited liability partnership is making overseas investment? See, there is no change in the the compliances that need to be done. I think an LLP is in, this was asked by Arth Joshi, right? Yeah. So LLP as well as company, irrespective of whether the investment is done by LLP or by company, the compliances remain the same. The investment has to be reported by filing Form FC Section A to E. That is number one. Next thing is that the limits have to be complied with. The maximum financial commitment, that is 400% of the net worth, that has to be complied with. Next, Initially, the UIN has to be generated, and then once the UIN is generated, remittance can be done. Uh, Debt can be provided into a foreign entity only if the Indian entity has existing ODI in the foreign entity. Share certificate has to be received within 180 days, submitted to the AD. APR has to be filed, FLA return has to be filed. So these are the standard compliances that need to be done by an Indian investor, Indian entity. So Indian entity is defined as both LLP as well as a company. So there is no difference between compliances that need to be done by an Indian company, a limited company, or by a limited liability partnership. Both are considered as Indian entities. Compliances remain the same. Next question, process if ODI made by LLP, but overseas company is not providing proper data, then how to file APR? Uh, this as part, okay, same. Queries. Okay. See, when when a Indian investor is making an investment outside, he has to be aware about the obligations. Number one. Second thing is that he also has to have a perspective of whether he can comply with those obligations or not. If there is any challenge or if he foresees any challenge in complying with the obligations, regulatory obligations placed on him, then I would say please don't make the investment. Other than that, I don't think any of us can give any other advice because these compliances are non-negotiable. RBI is not going to say that अच्छा आपका data नहीं आ रहा है तो आप APR मत file करो. That's not going to be the response that will come from the regulator. So, irrespective of whether you get the data or not, that is your problem. You have to necessarily file the APR. APR has to be filed, prepared, and filed in the required manner. And if there is a challenge in getting that, the kind of data that is needed to comply with your obligation, then it is better that that kind of an investment is not done at all. That is the best way. That is the best advice that we can provide us. Other than that, I don't think any of us can provide any sort of advice on this. How to regularize all previous defaults of ODI? Sir, ये तो this is Aniket sir. This is a is Mr. Aniket there? Rajat? Okay, he's also not. नहीं, this is an मतलब it's an extremely generic question. ये what is the kind of transaction? What is the kind of default that has happened? Uh, Without knowing that, how do we advise? How do we guide? Because each transaction will have its own set of complications, and as the age of the transaction increases, you will have more and more complications. Uh, Getting your stat auditor certificate itself will be such a great challenge. If you're looking at old transactions, probably your stat auditors might have changed, would have changed, definitely. If the transaction is more than 5 years old, obviously you would have changed your stat auditor. And it's possible that your current auditor is refusing to certify old transactions. You have a challenges in getting these stat auditor certificates. So depending upon the kind of transactions that is under default, and depending upon the kind of issues that are there, sometimes you will say that sir valuation report ही नहीं है. I'm not able to get the valuation report. Do you do? So those kind of challenges are there. So depending upon what kind of transaction you are talking about, depending upon what is the kind of challenge that you are facing, your way forward will change. So this kind of a generic question, I think it's something which puts us in a difficult situation to answer. So I can give you some broad perspectives for unreported financial commitment. You have to provide your Form FC and other supporting documents as are required by the AD. Transactions reported in the system, application for payment of LSF, pay LSF amount, obtain final acknowledgement. This is the standard process. And for APR, same thing. Obtain audited financials and prepare and file APR in a sequential manner. Make sure that, see, again, that is something which you need to, take care. If it's a regular client of yours, or if you're taking up a client for the first time, if he has got existing ODI, my strong suggestion to you would be to do a recon of APR data. Because a lot of times what you will find is that there are mismatches in the APR data. What the client is declaring, what the client is reporting in the APR, what is there in the the project profile. We have seen basic discrepancies such as inconsistency in financial commitment amounts. Happens quite a lot of times. The company might have done conversion of loan to equity. There might be a loan that was advanced and therefore it was brought back. So financial commitment actually in the client's books might have gone down, but it was not reported properly, and therefore it would still be outstanding in the project as per the project profile. So all these kind of things are there. So if you are taking up a client for the first time and you're starting to handle ODI transactions of that client for the first time, my strong suggestion would be, please do an APR recon from the beginning till today. Put all data in an Excel sheet, identify mismatches, try to regularize those mismatches, try to reconcile those mismatches. It will help you. It will make your job a lot easier. Is RBI approval route the only way to lend monies by a foreign subsidiary company to its overseas holding company without holding any shares? Can a company not lend overseas companies based on the control criteria? Madam, I think Akshita ma'am, I think, yeah. Ma'am, see, what is the meaning of control? What is the understanding of control? How does a subsidiary exert control on its holding company? By our general understanding, a subsidiary company does not have control in the holding company, right? So how can we say that control criteria is satisfied? See, the beneficial owners of the subsidiary company might exert control on the holding company by way of them being the promoters of the holding company as well. We have to look at the basic concepts under company law, which states that owners are different from the company. Control exercised by the owner is not the same as control exercised by the subsidiary company. The same person exerting control on the subsidiary company and the holding company does not mean that subsidiary company has control on the foreign company. That is number one. Second thing is that the regulation 3 of OI regulations, it states that for an Indian entity to advance debt to a foreign entity, three conditions must be satisfied. First condition is that the Indian entity should be eligible to make ODI, number one. Second condition is that the Indian entity, the lender, should have an existing ODI in the foreign entity, in the borrower. A subsidiary company does not have ODI in the holding company. It is the other way around. And third, the Indian entity, the lender, should exercise control on the foreign entity. So even if by any stretch of imagination, if we say that the Indian entity, subsidiary company, controls the holding company, even then, second condition does not get satisfied, no? Where when the subsidiary company is required to have ODI, existing ODI in the foreign entity, in the holding company, the lender does not have ODI in the borrower entity. And so that second condition is not satisfied. And for the Indian entity to lend, all the three conditions under Regulation 3 need to be satisfied. And honestly, if you go to RBI also with this kind of a request, this will not get approved. Your AD themselves will not take this request to RBI. If an ODI made earlier is now exited by sale of shares, Does the debt given earlier also need to be brought back, even if it is not due for payment as per the terms of debt? Uh, who had asked this? Then is not in the meeting. Okay. So basically, again, coming back to regulation 3, the Indian entity has to have ODI in the foreign borrower if the lender has to have a debt with the borrower. So if the Indian entity is disinvesting fully, is doing a full disinvestment from the foreign entity, then that ODI ends over there, correct? So basically, two things. One is that at the time of disinvestment, there should not be any pending receivable from the foreign entity. So that itself says that all the pending, all the principal amount should be brought back. Second thing is that if the loan is permitted to remain unpaid, then it violates uh, one of the conditions in Regulation 3 of the OI regulations, which is that Indian entity should have ODI in the foreign entity. When that ODI is getting terminated, that loan also should get terminated and should be brought. Whether the accounts of a foreign company required to be audited by a foreign CPA or can accounts be audited by Indian CA, I think I spoke about this. Uh, Dikshit ji, I think Dikshit sir is there in the session. I saw him entering. So I think, sir, I had covered this. Yes, some of the ADs, most of the ADs, in fact, they accept accounts that are audited by Indian auditors, and they do not insist on accounts to be audited by foreign CPAs. Uh, if it can be audited by the foreign CPAs, then not a problem. I mean, it's well and good. But most of the banks, they accept accounts that are audited by Indian CAs as well. There is no prescription in FEMA. FEMA simply says that audit should be done. APR should be prepared on the basis of audited financials. That is all that FEMA says. Other than that, who should do the audit? FEMA does not prescribe that. So that is left to the discretion of the ADs. If Indian citizens incorporate a company abroad, what will be timeline for FC reporting compliance? So I think when I had shared a slide earlier wherein we had talked about the due dates for different kinds of events. So when the company is being incorporated, the due date is that the date of incorporation or the date of signing the MOA. That is basically the due date for reporting. That is, when it has to be reported. So other than that, if there are any further events that you need to, discuss, we can talk about that. But when the financial commitment is being incurred, that is the date on which the reporting has to be done. Directors of Indian company incorporate company in Dubai when they visit the country and they fund the capital in cash. Later, they realize that the ODI procedure is not complied. They would like to make the Dubai company as a wholly owned subsidiary of the Indian company. What are the legal challenges? How AD banker will look at this? This was asked by Raghavan sir. I think you are, yeah, Raghavan sir. I think you are there in the group. So, Raghavan sir, I think need to understand a few more details. One is who are the subscribers to the foreign entity? Who sign? As per the MOA, who are the subscribers? Is it the director or is it the Indian entity? That is one thing that we need to understand.
It
So
is the
again, second
directors.
thing is that
It is the directors.
directors are the subscribers to the foreign entity. Correct.
Directors of
So
the
then,
wholly owned subsidiary Indian company also.
correct. Directors of the Indian company, they are, as per the MOA, they are the shareholders of the foreign company. Right. So the first thing to do over here is that, infusion by way of cash, that is not permitted. That is that is a prohibited way of incurring financial commitment. That is number one. Second thing is that this again, the other thing that we need to understand is uh, whether the transaction happened prior to 22nd August 2022 or post 22nd August 2022. Now we had a similar, case which we handled, wherein an Indian resident individual incorporated a company and infused capital by way of a non-permitted mode. Here, your directors have infused by way of cash. In my case, the resident individual infused capital by capitalizing the pre-incorporation expenses, which was a prohibited mode for resident individuals to invest under FEMA 120. Under OI rules, it is permitted. So if you're, if it is infused by way of a non-permitted mode, what when we went to RBI, this requires prior approval from RBI. So you have to file an application with RBI to regularize this. When you get the approval, you will get an instruction from RBI to regularize this by way of making a fresh infusion of capital to the extent of the share capital of the foreign entity. So outward remittance has to be done by the directors from India afresh. And once the outward remittance is done, RBI will also ask the existing infused capital, already infused capital, to be brought back. So an inward remittance has to be received by the directors. Evidence has to be provided to the AD of that money having been brought in and having been credited to the savings accounts, current accounts, whatever of the directors who have already provided that capital. Directors will have to file for compounding because they have contravened FEMA by investing in a non-permitted mode. APR has to be filed from the date of incorporation till date. APR has to be filed. So once we do all this, then the transaction becomes regular, the investment becomes regular. After we pay the LSF and do everything, all once we do all this, transaction becomes regular. Then after that, the directors can disinvest by selling their shares to the Indian company. Directors can get paid in INR. Directors will have to file Form FC Section G. Company will have to file Form FC Section A to E. And the shares can be transferred from the director to the company. Transaction can get closed. This is how it has to be done, sir. It's a complicated process for us. We started the process in 2022, ended
Yeah,
in
we are working with
2024.
HDFC on this. It's been very
Yes.
complicated. They are not. They don't know how to handle it. To be frank with you.
Sir, I usually do not comment about authorized dealers, but I can't, help but comment. I try to keep my transactions away from HDFC Bank, particularly HDFC Bank.
Exactly. Exactly.
I try to keep my transactions away from that particular authorized dealer. I've had phenomenally bad experiences. I advise, in fact, when clients come to me, I actively advise them to handle transactions if they have a way to do it, to do transactions through any other authorized dealer.
Because of one person there attitude.
Sir, I wouldn't comment upon on individuals, but in general, I find that that AD working with that AD to be an extremely difficult activity. FEMA, as it is very complex. Procedurally, also, it is very complex. We don't need unnecessary complications imposed upon you. At the end of the day, we work for clients, and we try to make our clients' lives easier. As it is so much difficult for us to negotiate all these kind of challenges and to get things done from our clients. We have to manage clients on one side, ADs on the other side. If we have a non-cooperative AD or where the procedures are unnecessarily complicated or complex as compared to the other ADs, then my preference is not to do my transactions through that AD and to handle it through somebody else. This is what I actively advise my clients. Anyway, that is completely out of the scope of our discussion over here. But I couldn't, when you said the name of that area, I couldn't help myself. Anyway, what is the procedure in case of foreign remittance beyond the permissible limit See, uh, obviously it requires approval from RBI. It has to be Form FC has to be filed by selecting approval route and not automatic route. You have to give a very strong justification, and you have to give mitigants as well. It again depends upon why the transaction is crossing the permissible limit. In the sense that see, a transaction crossing the permissible limit because of an outward remittance, an equity infusion, or a loan being provided, and a transaction crossing the permissible limit because of a guarantee being provided. These two are will be looked at in two different ways. Okay? So you have to provide justification as to why the breach is happening, what is the mitigant. You also have to give a timeline on within what time the transaction or the financial commitment will be brought within the permissible. This has to be provided without strong justification. First of all, you have to convince your authorized dealer to take the transaction to RBI. That itself is a huge challenge. And even after your AD agrees to take it to RBI, there will be strong pushback from RBI itself. Your AD has to be capable enough and has to be, I mean, convinced to provide valid justification to RBI and get the transaction processed. This will not happen in 2 weeks, 3 weeks time. You have to go with a timeline of 4 to 6 months for something like this. So that brings us to the end of our Q&A session on the questions received through the Google form. Would be happy to take up any further questions from the participants on this. Okay. So Praveen sir, so any investment, I mean, we had one experience of handling, I mean, a case of financial commitment by way of a non-permitted mode. And I will share my experience of how we did this. So you have to take it to the client's existing banker and you have to request them to present it to RBI for an approval. So uh, you have to put a request for generating I mean, a UIN for making a fresh remittance. So that money which was infused in the non-permitted mode, which cannot be considered as share capital. It would be considered as share capital in the books of the foreign entity, right? But from a FEMA perspective, you cannot consider it as a financial commitment. So which means that you will have to do a fresh outward remittance to the extent of the share capital for infusing equity in the foreign entity. And whatever transaction that was done, whatever infusion that was done in the non-permitted mode, that has to be subsequently brought back. So this is basically what the instruction that you will get from RBI. RBI will permit you. Number one, they will give you an approval to generate UI. Second, they will permit you to do an outward remittance to do fresh infusion of equity capital. Third, they will instruct you to bring back the already infused capital, which was infused through the non-permitted route. Number four, they will ask you to approach RBI for combo one. So these four instructions will be received from RBI. You have to convince you first. You have to convince your AD to take it to RBI.
No, actually, the basic problem which is coming up is the availability of funds to make further infusions. That's where I mean, the person who has approached us is stuck,
Ah,
and the amount is quite huge. It's I think it's almost 100 crores to the extent I understand. and they had cryptocurrency, and then they made the payment at that point of time because the valuations were a little bit higher. And now we are unable to sort it out. So I thought to ask this one, but I get your point that as far as the
Uh,
RBI is concerned, it will ask to route it. The another, I would say, the related question in that would be, what would be the effective date of investment in this case, the original investment? Because as far as the foreign company is concerned, in its book, the investment has already been made in the previous year, and they would have
correct,
reported it at their end. So how does
correct.
that impacts?
The date would be the original investment itself, because the RBI will ask you to file APR from the original investment date, and
Okay, okay. So
you will pay
basically,
LSF, you will pay
so
LSF
if
for
I
that also.
understand correctly, what you are saying is that as far as the ODI is concerned, the original financial commitment will be considered as commitment against deferred payment, and
Absolutely,
this payment
absolutely,
which will be rightly made now will be treated as the payment now, right?
absolutely. Yes, yes. This is
Okay,
how it
okay.
will work.
That makes it quite clear. That makes it quite clear. I have another question which I didn't wrote there. You were telling at the start of your presentation that the investment by way of ODI shall not exceed 400% of the net worth. So, is this net worth to be computed only once at the time of investment, or do we have to check it every year? I'll give you an example. In
Uh,
March 2023, an investment was made which was
mm,
around 380% of the net worth at that point of time.
right.
And as per the audited financials of March 2024, the net worth of the company has gone down. The amount of investment originally remains the same. So when we compute the percentage on March 24, even though there is
Mm.
no fresh transaction, the limit has crossed. I mean, the investment is beyond 400. So is it okay,
Understood.
or does this needs to be changed?
This is no, no. This is okay. The only thing is that the auditors will, I mean, probably put this as part of their audit comments in their, I mean, in the as part of their comments while auditing the financials. But from a FEMA perspective, there is no compulsion on the Indian investor bring back or to reduce the financial commitment to keep it within the 400% net worth. The only thing is that he will not be able to make any fresh financial commitment because it's already crossed 400%. So he will not
Okay.
be able to make any fresh financial commitment.
So it is only on the date of a transaction being made that we
Absolutely.
have to verify this limit.
Yes, yes, absolutely. Yes.
Okay. Okay. Thank you. Thank you. Thank
Okay.
you.
Sure. Sir, first and foremost, when did the gift happen? When was the gift received? Because under the ODI rules provisions, an Indian investor can receive gifts, shares by way of gift only in compliance with the provisions of Foreign Contribution Regulation Act. FCRA would become applicable in terms of shares being received as gift by by an Indian investor from of shares of a foreign entity being received by an Indian investor. So unless and until he or she complies with uh, FCRA provisions, that is being registered under FCRA and then getting permission to receive this, it will not, the shares would not be considered as a valid investment, right? And he would have to undergo compounding for having accepted these shares as gift and thereby, I mean, making the investment. Second thing is that even if these shares were received as gift prior to 22nd August 2022, acceptance
Mhm.
of shares and becoming a shareholder in a foreign entity, it triggers a reporting requirement. the Indian
Mhm.
individual should have reported the receipt of these shares and should have generated a UIN. Unless, but the only exemption over here is that if the transaction is less than 10%, then you can consider it as OPI, right?
Right.
I mean, if it is sweat equity shares or ESOPs, etc., received by for Indian resident individuals, I mean, then those kind of transactions can be considered as OPI. Other than
Mhm.
that, any other transaction will be considered as ODI, and it has to be reported in Form FC section A to E. So the first and
Okay.
foremost thing to be done over here is to regularize the receipt of gift, either by,
Mhm.
a way of getting an FCRA approval. If this was received, after 22nd of August 2022, or by way of filing Form FC section A to E, if it was received prior to 22nd August 2022. Subsequent to that, all further transfers, etc., can be done. So
Okay.
UIN has to be generated and transaction has to be taken to, has to be handled in that particular manner.
But in this case, since the resident individual, like the company has a step down subsidiary,
Hmm.
would it be a problem to get an approval?
Absolutely, absolutely. Because you see, if it is OPI, not a problem. But if it is,
Mhm.
if they, again, what is the kind of percentage that they are holding? If they are holding less
They
than
are
10%,
no,
and
they
if
are
it is,
holding actually 100. It's 100% of the foreign entity.
then there will be no way that they can get a approval, sir. And in fact, this was a
Mhm.
a very common way of trying to evade the FEMA provisions
Yeah.
prior to 22nd August 2022, and that is this was the requirement under OI rules for
Mhm.
having FCRA to comply with FCRA provisions to accept
Okay.
gifts. It was brought in specifically to counter these sort of transactions. Typically, what will
Okay.
happen is that the resident
Mhm.
individuals will want to set up a holding company abroad, and for the purposes of, for tax purposes, which will
Right.
be, which will hold subsidiaries in India and in other countries. So the Indian
Correct.
entity, Indian company will repatriate its profits to the foreign entity, and
Correct.
they will the ultimate beneficial owners are sitting in India, and they have a tax advantage for holding shares in that particular entity.
Right.
So there was lack of clarity on reporting for gift transactions. In fact, I wrote an article about this particular
Mhm.
loophole in a business line
Mhm. Okay.
quite long back.
Okay.
This was a loophole which was being utilized by resident individuals quite frequently in the FEMA
Right.
120 regime.
Right.
And this is a non-permitted transaction. They will not get an approval for this, and they will have
Okay.
to unwind the transaction, and they will have to approach for compounding.
Okay. So this transaction was actually done way back in 2018 or 17. So
Right.
now, like under that regime, like you said, right, there was loophole. So would if we go for compliance for the current transaction, would it cost, would they ask us to even comply with the old one?
Yes, yes, absolutely. The transaction happened in
Okay.
2018, so it has to comply with, the provisions of FEMA 120. Now,
Yeah.
this will be considered as a transaction which was structured and put through deliberately to contravene the existing provisions of FEMA. That is how the
Mm-hmm.
regulator and any other investigative agency will look at it.
Mm-hmm.
uh, because that is I mean, to be very honest, that is the primary purpose of putting
Right.
together
Right.
this sort of transaction. So this would be looked at
Understood.
in that particular manner itself. Compliance has to
Mm-hmm.
be done under the old regime and not under the existing regime, because transaction
Mm-hmm.
happened in 2018.
Right. Sure. Sure. Thank you. Thank you.
Right. So, what you're saying is that if my wife has not utilized her LRS limit, can I remit $500,000? That is basically. I mean, I understand, Akshata ma'am. That's the question that you're asking, right? Is that the question? So, I cannot utilize the LRS limit of another person, even if we are from the same family. I cannot utilize the LRS limit of another person. That person can invest particularly for the purpose of overseas investment transactions. You cannot accumulate or you cannot utilize it cumulatively for the purposes of from family members. Each individual will have to do the outward remittance individually from their own personal account under their own plan, and that will have to be utilized in that particular plan.
Okay, sir.
FDI we will sir, FDI we will look at it in a specific session. Raghavan sir, yes. Uh, Varney sir, I think this is a you can look at it both ways. AD can interpret it both ways. My suggestion would be to approach through the approval route if you want to do it prior to 1 year from the date of investment. But you can argue that the original investment was done when the subscription was done in the non-permitted manner, because particularly if you are filing APR, the thought process behind that 1 year time frame is that uh, the existing investor should have filed at least one APR. That is the thought process. So when you look at it from that perspective, uh, if the directors have filed the APR, then you can argue that he has remained invested for more than 1 year, and therefore he should be permitted to disinvest.
Thank you.
Sorry, sir. So what you are saying is that Mr. X is a shareholder in a company over here, and company so XYZ Private Limited is the company in which he is a shareholder. XYZ Private Limited is incorporating a company outside India and doing an overseas investment. Can Mr. X, who is a shareholder in company XYZ in India, also be a shareholder in the foreign entity? Is this the question that you're asking, sir?
Sir, actually, I'm talking from the individual angle, not from company angle.
Okay,
Individual.
so can you,
Individual.
so Mr. X is incorporating a company outside India.
Along with some other partner who is a resident of that country.
Achha, who's a resident of that country? Okay.
50-50. 50% is the shareholding.
Okay, so your question is that can a resident individual
Yes.
incorporate a joint venture
Yes.
in another country?
Another country.
And with shareholding from another party.
He's pumping the fund from India from his individual account
Okay.
to the same entity,
Okay.
So in which he is also 50% shareholder.
So Raman, if he's a 50% shareholder,
Yeah.
so yeah, let's say for example, the share capital of the foreign entity, the company is being incorporated, let's say in Dubai,
Yeah.
and the authorized capital is 100,000 dirhams,
Okay.
and the resident individual is holding 50% shares in the foreign entity.
Yeah.
Then the resident individual can remit 50,000 dirhams in the foreign entity as from his savings account. It has to be from his savings account.
Yeah,
He
correct.
has to remit 50,000 dirhams to the foreign entity's bank account for
Yeah,
acquiring the 50% shares.
yeah.
That is how it has to be done.
Okay, that is allowed.
Yeah, that is allowed. Yes,
Any
absolutely.
reporting procedures, sir? Any reporting procedures like?
Absolutely, sir. Your regular overseas investment reporting procedure, Form FC, Section A
Uh,
to E,
hmm.
when the foreign entity is being incorporated, at that point of time itself, the Form FC Section A to E should have been filed. And if it has not been filed, it has to be filed right now.
Okay.
And then, when the once the UIN is generated, subsequent to that, the outward remittance can be done by filing Form FC Section A to E once again.
Any limit is there, sir? Any threshold limit
Two
so
lakh,
that
yeah, $250,000 per financial year for resident individuals.
that means up to 2 lakh 50 US dollars we need not report, sir? You mean to say?
No, sir. No, sir. Up to even $1 going out, it has to be reported and UIN has to be obtained. The
Oh,
maximum permit beyond $250,000, the resident individual cannot remit at
yeah,
all.
yeah, yeah. Correct, correct, correct. So that UN and all we need to regenerate through this FEMA and RBI.
Yes, yes, yes,
Okay.
sir.
Thank you so much, sir. Thank you so much.
Right, right.
Sir, sorry, I have a doubt. Can I? It's a very small doubt, but I just have. Can I ask, sir?
Sure, sure, sure.
So I just want to know about APR due date. Usually APR due date is December 31st of the next year. Of the due date of, like, if my foreign entity financials are closing on a December 31st this year, I have to file it by December 31st next year. And now, if my foreign entity financials are closing on December 30th, or like any month, November 30th or June 30th, something like that, then what would be the APR due date would be, sir?
So this is a quite an interesting situation.
Yes, sir.
Typically, we take no, we take 31st March, 30th June,
Yes.
31st December, right? Now, obviously, there are companies which have like a financial year closure on other dates as well. There might be 30th of September also in some cases, or 30th of November, etc., etc. The only thing is that, see, from a FEMA perspective, the only leeway provided is for companies whose financials are getting closed on 31st of December.
Yes.
Then your APR gets due as on 31st of December of the next year. If
Yes.
your foreign entities financials are getting closed on any other dates, whether it be 30th of September or 30th of June, etc., etc., then it is due by 31st of December of that particular year itself. So this is a challenge.
Yes, sir.
See,
Yeah.
June you would still have time. 6 months time you would have to get audited financials and to do it. But if it is say 30th of September or 31st of October, etc., then you would have a challenge. But yeah, it is a very real challenge.
We had a company, so which is closing on 30th November. Now the in-house team are saying we can file it till next December. So
We can't.
that is the
No,
thing
we
I
can't.
told. No, we
We
cannot.
can't. We can't. We cannot. We can.
Exactly.
There is
That's
no provision. There is no provision in FEMA. The leeway under FEMA is provided only for companies, foreign entities whose financials are getting closed on 31st of December 2020,
yes.
December 31st of December only.
Yes, sir. So we told even if you're closing on 30th December, you have to file it on 31st December.
Absolutely.
There is no
Yes.
way there is exception. So this
Yes.
is, I just want a clarity because there is no written rule actually. That's what I.
There is no return. There is no. Yes, Rajat. Any other? Okay. Okay. So then in that case, I think we can. Yeah.
Very well. Very well.
Thank you so much,
I
Rajat
just
sir.
want to put a word, Mr. Abin. It was actually very nice, especially people always actually have a good knowledge on FDI, but very few people on ODI. Yes, actually people have doubts. Actually, everybody thinks I know ODI, but no, people will not know have 100%. Even I think yeah, I myself had understood so much today, and especially it's a very nice way to start a month, first June. I think this June I definitely know. Very good way to start the knowledge building. Thank you very much. As my boss used to always tell, actually, saying that when we used to go on some bigger, behind some money, he used to say, go and learn. That is Saraswati, Lakshmi will follow. I think today, we have actually learned Saraswati. I think many professionals or all this, Lakshmi will anyway follow if you have knowledge.
Well, absolutely. Today is also Sandashashti. So that way also today is a great day, right? So absolutely good way to start the week and month. Thank you, Rajat. Thank you for
Yeah,
organizing
thank you,
this,
Rajat. Yeah,
and
thank you,
thank
everybody.
you for putting together everyone. And thanks a lot for everyone who has taken time out on a Sunday and having brought these questions for us to discuss. Thank
Yes, I
you.
think we also have to thank our families, which they also
Oh,
told we'll not disturb you for
absolutely,
2 hours.
absolutely, yes.
Because these are the days, these are the time we spend time family on Sunday. But we
Either
also have to
sir,
thank each and everybody's family.
either sir. Great for you to join us, sir.
Thank you, sir. It's always a pleasure. It's always a
Yes,
pleasure
sir.
to be, listen to somebody like you talking about
Yes, yes,
most
yes.
complicated subject. As Raghavan rightly said, out of 10 cases, FEMA cases, at least 8 of them are FDI cases. Only 2 of them are ODI cases. So the exposure, any professional for that matter, the exposure we have on ODI is relatively lesser than FDI.
Yeah, yeah,
Thanks
correct.
for opening our eyes. Thanks for the knowledge that you have shared. Thank you so much. It was a great Sunday morning.
Thank you,
Yes,
sir.
yes. Thank you. Thank you. Very
Thank you.
kind of you, everybody. Bye. Bye.
Wonderful. Looking forward for more sessions, sir.
Yes,
Thank
sir.
you.
Thank
Bye,
you.
sir.
Thank you, everybody.
Very. Thank you.
Thank you.